Okay, the company I'm going to talk about is Dye Durham Limited, DND on the TSX, trades around $15.54, just over a billion market cap. It says nil yield. It's just a very small yield. It's 0.004%. For some reason, they pay a dividend annually. It's really absolutely useless and inappropriate given the debt. We'll kind of go into that in a second. What does Dye Durham do? They're a provider of practice management software, data solutions, and payment technology to law firms and businesses. The company has over 60,000 clients in Canada and international markets. It's based in Toronto, Canada. Now, I'm going to give you a snapshot here of the business financially over the past 10 years. Hopefully this will help. We can see revenue growth look great for 9 years, from 1.9 million in 2011 to 478.8 million in 2022, before declining to 451 million in 2023. Operating income shows a similar trend, 9 years of strong growth before dropping off in 2023. If we look at debt here, sharp increase through the period with a huge step up from 2021 to 2022. And the interest expense just keeps mounting with higher and higher debt and higher interest rates over that period. Debt was essentially to fund a massive acquisition spree. Many were consummated at elevated prices, I would say. Now let's look at the shares outstanding over this period too. You can see just significant continued increase in the share count outstanding of the business. This doesn't include, I believe, a recent financing or perhaps on the trailing 12-month figure there when you get up to about 67 million. We do include that. Now let's look at the second quarter highlights here. Revenues, it shows up 17%. But that's after taking out a recent sale or divestiture of the TM group there. Revenues, if you include that into the business, were up just 3% in the period. The net loss, 34.8 million. It's stable compared to the same period of last year. Adjusted EBITDA, 60 million. That's an increase of just 4% over that period. Let's look at the valuations. On an EV to EBITDA basis, despite the share price being far off from its high, significantly depressed, is about 17.65. The EV to EBITDA forward, these are based on what I would say are some very optimistic estimates, is around 9. The PE, because there is no earnings, you can't really calculate that. So let's look at recent news here, and this continues a trend for the business. They announced they'd entered into an agreement with Canaccord to essentially do a financing, issued 10.4 million shares at $12.10, raising 126 million. What do they intend to do with the net proceeds? They intend to pay off and repay some of their debt. It's consistent with the company's stated goals over the past year to reduce their leverage ratio to less than 4 times. The company is not issuing shares for growth purposes, but again, to pay down debt. Shareholders continue to pay for a company that tried to expand far too fast and over-leveraged itself. Dye Durham is likely into a cycle of either asset sales, we saw that already, shrinking the business, and or continued equity dilution to pay down debt. So my quick conclusion here is Dye Durham has some very useful, in some cases well-reviewed software servicing the legal industry. As a public entity, however, the company has been managed very poorly, and its current debt situation leaves the business playing defense. We would just monitor the business at present, but are not buying it. I'm going to say that investing within a sector, or generally speaking, the decision to buy or pass on a stock takes into account the alternatives for where your capital can go. In the case of DND, our current coverage essentially includes 3 to 4 companies or names with net cash in the software sector with higher organic growth, and in most cases equivalent to lower multiples. Companies that are not over leveraged with cash just have so many other ways to deploy their capital that can create value for shareholders. They can buy back shares, pay dividends, invest in the business, or buy other businesses to grow. We prefer to play in that pool rather than the one where we're speculating on deleverage, selling off assets, to improve the current poor situation. The more you play in the net cash pool, the better your chance of success over the long term. And that's me on my soapbox right at the end.
Listen to you.
Okay.
Yeah, I mean, when you look at that debt situation, you've got debt continuing to increase, substantial levels of debt
Mm-hmm.
continuing to increase, while then revenues and operating income are going down, and you're still not profitable. So we've seen situations where companies have levered up their balance sheets in order to make a big acquisition. This can be a risky proposition, but if you're able to then pay down the debt with operating cash flow, free cash flow from those new assets, then it makes sense. Then that's a successful accretive transaction. But having to then go back to the market, raise shares at, I mean, it's the share price is way down. The valuation is still not cheap. So I guess at the current valuation, it's not that bad for the company, but still you're raising shares just to pay down debt. You should be paying down debt with free cash flow. Obviously, there is something wrong with the capital allocation strategy there, and they're just beginning to realize that.
Yeah, I mean, just to give you an idea too, between 2020, I believe, and 2022, the company shares were basically, above the $40 range, slightly below, but, hit 50 something at some point. It trades in the $15 range today. That's when it was going on, this acquisition spree, promising tremendous growth. And it really just levered itself out to do this, not on a responsible basis. And then, shareholders who bought into this blue sky potential, tremendous, and it was in a lower debt environment, but into that tremendous just growth, buying businesses at any price, buying at high valuations, not focusing on organic growth. Well, you can see what's happened to the share price. It's significant. It's gone down from the $40 range to the $15 range. Now they're having to, they raised capital, significant capital, diluting shareholders at $12. I mean, that again, not only is paying off like 10% or something of their debt too. This cycle will have to continue. How do you now? There isn't a ton of organic growth here, it appears. So if you continue to have to now, how do you grow? Do you buy more businesses? Well, you can't. You've got too much debt. Do you issue shares? Well, you say you're trading at significantly low forward valuations. Why would you want to continue to issue shares? And again, they had to issue shares just to start to pay down some of this high interest debt. It's just expanding too fast, getting ahead of your skis, so to speak, before, and not wanting to grow out of cash flow. And, you end up with a business that looked great at one point, on the surface, but really the underlying business there and the structure and the way you're building that business isn't sustainable. And then the house of cards gets pulled out from under you. And here you have this situation that you're in where it's going to be very difficult for them to grow going forward. And it's all about playing defense, trying to pay down debt, selling off assets. I'm there may be an argument made here that the sum of the parts is worth more than what you're looking at now in the market. We like to analyze cash flow, and cash flow is decreasing right now, and the business, is paying a dividend for some reason. I mean, just the capital allocation discipline from this management team, which again is changing, it looks like, is just poor. And we want to see good capital allocation, and it's just not there. Hasn't been there for Dye Durham.